A very good afternoon to all of you. Today we're gonna discuss the chartered exam, the corporate level tax paper, which is that as per the latest revision, syllabus revision, that is a comprise with for 55 marks goes to corporate law. That is incorporation, winding up, and other law adjacent to the corporate law. The previous, I don't know, the liquidator. Then it's referring to that Companies Act. You need to keep remember that. Then there is a 45 mark out of 100 marks. 55 is for corporate law, 45 for taxation. The corporate tax mainly it comprised with value added tax and corporate income tax. Simple CIT calculations. You need to be logical how the CIT, the corporate income tax line is deriving in terms of as per the inland revenue requirements and amendment they are on, further amendments they are on, and you have that tax administration, the time bar provisions, what are the due dates and administrative review, that tax appeal commission, and then how so on, how to deal with tax disputes if you received an assessment, how to work on that. So that kind of area, simple. So I think a small area is covered in this paper. So without further elaboration, let me go through with that. I would say that here this paper, pilot paper, because we don't have much more papers in terms of the syllabus. This is the first batch go for that exam. So let me start the question number 8. That is for 25 marks. Definite question is there out of 45. For the CIT computation, you need to calculate the gross income tax, though the balance tax payable after deducting the because you have accessible business income, investment income, and other income. Do you have total accessible income? Then you have to deduct the qualifying payments. Then you have a taxable income. Based on the taxable income, you may apply the relevant applicable tax rate. Either it is 30% for the companies except the liquor companies, or 15% for the export companies. By the capital gains tax, you have this they are disposed to something gain that's subject to 30% again, and you have to derive the gross income tax liability. Therefore, you need to deduct the tax credit, let's say withholding tax credit, because based on the FD, if you have FD, you have a suppose WG certificate, rental income, you have a WG certificate. Oh, and what? Yeah, self-assessed income tax, because you need to pay for installment based on the self-assessment basis to remit to the IRD. Therefore, you also that can also you can take as a tax credit as a when deriving the balance tax payable. So that is the logic, but you need to apply that logic for the given context or the given paper. That's the thing you have to do. So therefore, we will start the question. So introduction, I'm reading. Tech Solution is a company incorporated in Sri Lanka in 2012, operating in IT and digital transformation space. Its clientele includes SMEs and large corporations, domestically and internationally. Okay. So revenue streams, what are the revenue income sources? The company earns revenue mainly through development of licensing, provisioning of customized software, digital transformation service, IT outsource, providing ongoing technical support and managing a client IT's infrastructure. So staff augmentation in the sense providing specialized IT professional to work directly in the client's Intel projects for the specified stipulated time period. Okay. So the company main source of funding include equity, because this is their capital structure. We call the equity. Though you learn in the I think if capital sorry corporate finance, Modigliani and Miller capital structure levels theory, whatever. The weighted average cost of capital WACC, we call WACC. Here it's not given for that purpose. This is not a corporate finance paper. This is given for that. I think thin capitalization rule or the maximum upper limit for the interest reduction that apply as per the IRD requirements. So the company main source of funding input equity capital and substantial loan facility, that is the debt instrument from the parent company here on. So we don't that much. It's important for an application. TSL has entered into agreement with Tech Cloud PT Limited, Singapore, a current technology provider which supplies the technological platforms, cloud infrastructure, and required for service delivery. It's given like that. Okay. Payments for the foreign company include license royalty fees because that is mandatory to the in order to incur the expenses are incurred in the production of income. Unless made in this payment, you can't continue the business. Because that is mandatory. Anyhow, you need to incur. Okay. Planning expansion, port city entity. TSL plans to incorporate a separate entity, port city, with the support of foreign affiliated company to cater international clients. But the port city will focus global service because global service delivery with potential tax concession and investor-friendly regulation. Okay. Additional information, the P&L is given. So you know that we are starting in order to derive the assessable business income. We are starting from profit before tax. We are adjusting the PBT based on we are disallowing some expense, we are allowing some expense, we are getting the accessible business income. Then we have to add the accessible investment income, total accessible income, deducting qualifying payment, taxable income by applying the tax rate. You have gross tax liability by deducting the tax credit. You have a balance tax payable. That is the process you need to remember for surely. Okay. So the revenue is there, the operating income, not the selling and distribution expense because the revenue. So if I say, so you need to know provisions when Kirim not allowed. Cash basis, yeah, cash basis, cash paid amounts are allowed unless the provision, the word provision itself, it is not allowed. It may disallow from the CIT computation that you need to know very well, otherwise you will ended up with the wrong answer. Okay. So here you have professional fees, bad and doubtful web. Okay, entertainment not allowed actually. Entertainment sometimes it may be allowed based on the context. That is a CSR expense, depreciation amortization anyway not allowed instead of that. Sorry, we have to charge the capital allowances as per the given useful life in the IRD Acts. Okay. If it's a land and land not subject to depreciation or anyway, no. A billion 20 years or 5% per annum. Okay. Finance cost is given these two for that in capitalization rule. So finance income is given because this is an investment income. So foreign currency business unit means let's say USD account, FD in USD that is not subject to withholding tax deduction because the foreign currency FDs are not subject to 10% WTC tax interest. You know that based on the interest, 10% WTC is deducted. If you have a saving account, you may seen that. I think all have saving account even though have 5,000 or something stated capital, those are given. You need to remember that when calculating the thin capitalization, you need to remove or omit the revaluation reserve. Otherwise, you will ended up with a fail. Okay. Detail of PPE opening cost, cost of disposal and matter series. There is additions, so you know that the year of acquisition you can claim the full year capital allowances, but when it come to the year of disposal, you need to think at the year of assessment, particular year of assessment disposal year, you are not allowed to charge or you are not allowed supposed to claim the capital allowances. That is stipulated in the act. Also balance is given. So some adjustments are given. So sorry, we have to calculate the income tax payable, calculate the tax liability on disposal of shares, is the benefit accrual though. So we are focusing on this one. So give me a 2 to 3 minutes. I will give you to read the question. Read out the question.